Well, hello, everyone. Cynthia Tomaine once again with Interactive Brokers, and thank you for joining us this afternoon as we take a look at evaluating smart beta ETFs. Smart beta represents one of the biggest trends in index investing, but sorting through the ETF issuers' competing claims would be a full-time job. Now, in today's webinar, Michael Krause, who is the president of AltaVista Research, will go beyond the hype to examine what smart beta really means and discuss objective ways to evaluate these popular ETFs, including newer funds with little trading history. He'll also show you how to calculate the true cost of smart beta ETFs so you'll know how to find the most bang for your smart beta buck. So with that, let me go ahead. I'm going to put this over on today's presentation, and if you would all please help me welcome Michael Krause, who is president of AltaVista Research. So with that, Michael, I'm actually going to pass you the ball so that we can go ahead and get underway today. Thanks for joining us, Michael.
Thank you very much, Cynthia, and good afternoon to everyone. Thank you for joining us. As Cynthia mentioned, today's topic of evaluating smart beta ETFs is one that is very popular and also a bit controversial in the world of indexing investments. But I do hope and believe that the next half hour or so will be both informative and very helpful to you in a very real, practical sense. So to begin with, smart beta is a very widely used yet ill-defined term. But if we look back at how it developed, we can get a sense of how it applies to ETFs and other index-based investments. One of the earliest developments of something that would now be called smart beta was the introduction of fundamental indices by research affiliates in 2004. Instead of weighting the index constituents by market cap, as is the case with widely followed indices such as the S&P 500, a fundamentally weighted index weights each constituent by measures of a firm's financial size. So in the case of this particular index, it was the size of revenue, earnings, dividends, and book value. So today, smart beta has grown to encompass much more, whether fundamental measures or trading measures such as volatility and momentum. For our purposes, we're simply going to define smart beta to include any alternative to a market cap-based index that aims to outperform the market in a rules-based way. And we say rules-based, meaning that the index has clear written rules for what stocks are to be included and at what weights, as opposed to, for example, an actively managed mutual fund in which the portfolio manager has personal discretion. Now, smart beta can also include something as simple as the many dividend-oriented indices, and some of them have been around for decades. So in that sense, smart beta is sometimes viewed by its detractors as a repackaged version of value investing. And proponents of traditional cap-weighted indices see the so-called smart beta indices as a foolish attempt to beat the market over the long term, which they correctly note that very few strategies have accomplished. And of course, a lot of people are unhappy with the implication that something which isn't smart beta must therefore be dumb beta. Our purpose today, though, isn't to resolve this debate, but rather to help you evaluate if smart beta ETFs are right for your portfolio. But I will make 2 points on the topic. The first is that smart beta ETFs are not a fad. By our count, such ETFs now account for about 1/3 of all equity ETFs, shown here on the slide in the pie chart as style and fundamental indices. So they account for about 1/3 of all equity ETFs and at least 22% of the assets, probably a little bit more. And the second point I would make is that traditional indices such as the S&P 500 are not the model of market purity that many adherents to traditional index investing like to think they are. Think, for example, during the late 1990s when the latest tech IPOs were being added at a very quick pace. Some of them had to be removed just months after they entered the S&P 500 because they went bankrupt. Then again, think in the mid-2000s where there was a change in the longstanding rule against the inclusion of real estate investment trusts. So towards the end of the greatest real estate bubble, they started including lots of real estate companies. And in addition to that, there are changing measures of what constitutes market cap. So some participants have correctly, I think, criticized the S&P 500 as sometimes a bit of an actively managed closet case. So it's not the pure market exposure that you might expect. So there are always some degrees of smart beta, if you will. The problem when it comes to investing in smart beta ETFs and evaluating them is that there are simply so many choices. Given enough time, an investor could read through a fund's marketing materials and the prospectus and detailing the methodology behind an index's construction, including details such as the universe from which stocks are chosen and their selection criteria, the weighting and rebalancing. And the details themselves may be easy enough to understand, but an investor is still left wondering, so is that good? If I'm looking at dividend funds, is the yield weighting of Fund A better than the dividend size weighting of Fund B? And what about an equally weighted index of high dividend stocks? Sorting through these competing claims from the various funds is a bit of a nightmare. And what it all means on a practical level is far from clear. Now, evaluating smart beta ETFs is further complicated by the fact that many of these have very limited performance history. Enter the back test. Because smart beta funds are rules-based, fund companies are actually permitted to present hypothetical figures of how the index might have performed had it existed. And of course, any back test you're seeing is bound to look good, otherwise you wouldn't be seeing it. And there's nothing wrong with looking at a back test per se, but the problem with them is twofold. Number one, the standard 10-year presentation that most back tests encompass is about one market cycle, bull and bear market, give or take a year or two. But that's not long enough to tell you how those stocks might have performed in different market cycles. And number two, the bigger reason, as most of us know, is that past performance is simply not indicative of future results. So what is an investor to do? After analyzing more than 1,000 ETFs, including hundreds of smart beta funds, we've developed a fairly simple three-step checklist that we think can help the average investor to evaluate smart beta funds and determine which ones are right for their portfolio. The steps are, number one, is it a single or multi-factor fund? Single funds, that is, those that isolate just one aspect of performance and then load up on stocks that meet that one criteria, they often have major drawbacks that we'll explain in a moment. Number two on the checklist is it sufficiently different from, quote unquote, dumb beta? You'd be surprised how many smart beta funds look a lot like their traditional index counterparts, yet they cost significantly more. So we'll show you how to determine if a smart beta fund is a near clone of a cap-weighted index, as well as to calculate the true cost of smart beta. Finally, number three, are the fundamentals appealing? Now, ETF analysis really doesn't need to be that different from stock analysis. Things like earnings growth and PE ratios can tell you a great deal about how two smart beta funds are different from each other or different from a traditional index fund. And we'll show you where to find that information. So to begin with, we'll look at checklist item number one. Is it a single or multi-factor fund? As a general rule, we think investors should be cautious with single-factor funds for the reason that while trying to isolate and load up on one investment factor deemed desirable, such as yield, for example, they often inadvertently end up introducing a new bias to the index or some sort of risky concentration, and as a result, they end up reducing the original diversification benefit of index investing. For example, take the Power Shares High Yield Equity Dividend Achievers Fund shown here in the pie chart on the right. This is ticker symbol PEY. PEY is a dividend-oriented single-factor ETF weighted by yield. So not surprisingly, it is tilted towards typically high dividend-paying sectors like utilities and staples at the expense of primarily technology. Now, that's probably not surprising as long as investors are aware of it. It's not necessarily a problem by itself. But the point is it should not be viewed as a buy and forget investment like a broad index fund. Now, that became abundantly clear during the financial crisis. Back in September 2008, it was the financial sector that had exceptionally high yields because investors had correctly anticipated that dividends would be cut and they sold shares, driving yields up. But until those dividends were actually cut, stocks in the financial sector had very high yields, and hence this single factor fund loaded up on financials to the tune of, at that point, it was about 75% of the assets in this one troubled sector. Obviously not a good idea, and not something that's appropriate for a core set it and forget it type holding in your portfolio. Now, I should mention as a side note, since then, the index that PEY tracks has adopted some diversification requirements that limit a single sector to 25% upon rebalancing. But this still illustrates how single factor funds can become quite tilted and therefore lose some of the diversification benefits of index investing. Another good example is the Spider Russell 1000 Low Volatility ETF, ticker symbol LGLV. Generally, low volatility is a good thing, and the funds that make up the stocks from, and this fund is drawn from the lower volatility stocks that make up the broader Russell 1000 index. And indeed, they have been less volatile on average. Specifically, if we look back past 3 years, these stocks are 33% less volatile on average than those in the broader Russell 1000 fund, which is ticker symbol IWB. But because these low volatility stocks tend to share many other characteristics, that when you combine them into an index, they tend to have higher correlations. In other words, they all trade together. And thus, you end up not getting as much bang for your buck. So whereas they were 33% less volatile on average, when you combine them into an index, they don't lower volatility as much as you would think. Again, measured over the same past 3 years, the low volatility fund here lowers volatility only 8% lower than the standard index, not the 33% that you get just in looking at the stocks by themselves. Also, when we see that a smart beta fund may have outperformed its market cap weighted counterpart over the past few years, whether it's actual performance or a back test, that history isn't likely long enough to be definitive. Factors come in and out of style on Wall Street, and what drove returns in the tech boom of the 90s isn't what drove returns in the first half of the 2000s. And in recent years, so-called growth stocks have outperformed value for an extended period. But it would be a mistake to simply extrapolate this trend forever into the future and erroneously conclude that growth must be better than value stocks because, look, it's done so well over the last 10 years. So you don't have to avoid single-factor, smart beta funds altogether, but just realize that they can go off the rails and they sometimes don't resemble a broad index as much as you might think. So single-factor funds, I think, are therefore best used in shorter periods when you expect a particular market environment to prevail for a time. So be very cautious about using single-factor smart beta ETFs in a portfolio as a long-term, set it and forget it type investment. Number 2 item on our checklist is the smart beta fund different enough from a quote-unquote dumb beta fund? If a smart beta fund is going to achieve its objective, which, as we said earlier, is to outperform a traditional market cap weighted benchmark over time, then it will need to offer different exposures than those offered by the benchmark. In other words, the part of the smart beta fund which is unique to it will have to generate whatever outperformance there is, because the part of the portfolio which is identical to the benchmark will obviously generate identical returns. And because smart beta funds typically cost more than their traditional cap-weighted counterparts, the unique part of the portfolio must first overcome those additional costs before they can generate any excess returns for shareholders. We've developed a tool on Trader's Workstation that can help you determine how much of a smart beta's portfolio is really unique to it versus other similar ETFs. It's called Alternative ETF Finder, and Cynthia will show you where to find it at the end of this presentation. But once you open it up, it will look like the screenshot here on the left-hand side of the slide. So you simply enter a ticker symbol for any smart beta ETF that you want to investigate and hit the button to find alternative ETFs. The results will display in a list of similar funds based on their overlapping positions. The overlap is a percentage of the two portfolios that are identical by weight. So, for example, if Fund A has 3% in Apple and Fund B has 2%, their overlapping positions are 2%. So this table will also show you the expense ratio of the alternative funds, as well as a link to our detailed research reports on each fund, should you ever wish to subscribe to that. However, the tool you're looking at here itself is free. Now, you might be surprised how much overlap there is between some smart beta funds and their benchmark counterparts. There's nothing inherently wrong with that, but remember, if a smart beta fund has only a small portion of the portfolio that is unique to it, then there is only a limited portion with which to overcome the cost disadvantage and deliver excess returns. So, for example, here we've chosen the Schwab Fundamental Broad Market ETF, ticker symbol FNDB. As an example of a smart beta ETF, it's a well-diversified multi-factor ETF. But it's really just a fundamentally weighted version of the Schwab US Broad Market ETF, ticker symbol SCHB, which is a traditional cap-weighted index fund. So using the app, we find that the overlap between these two is 71% by weight. Perhaps that's not surprising, but it means that the, quote-unquote smart part of the portfolio is just 29%. So if FNDB is to overcome its higher fees and generate any outperformance for shareholders, it's going to have to accomplish that with just 29% of its portfolio. To help you think about whether that's a hurdle too high or whether it's a reasonable trade-off, we can calculate what we call the smart cost. The formula is a simple one and is shown here on the right. FNDB has an expense ratio of 32 basis points, while for the benchmark SCHB, the expense ratio is only 3 basis points. Now, on the belief that the 71% of the portfolios which overlap is only worth paying 3 basis points, since that's what I can get it for by using SCHB, we subtract that cost from the 32 basis point price of the smart beta fund in order to get the additional cost of the smart beta, which is 29 basis points. But again, since the unique portion of the fund is just 29%, we divide that additional cost by the unique portion to yield the smart cost, which is 100 basis points. So another way to think about this is, if the smart beta fund were totally unique, that is, if it had zero overlap with a benchmark ETF, then it would need to generate 100 basis points, or 1%, of outperformance each year to compensate for its higher cost before it would deliver higher returns to shareholders. Is that impossible? No. In some years, it almost certainly will outperform by that amount, while in other years it'll fall short. But 1% per year is not an insignificant hurdle to overcome. And this example turns out to be pretty middle of the road for smart beta funds. There are some diverse multi-factor funds with overlapping portions as low as about 50%, which is a good thing, meaning that the other half of the portfolio would be unique to it and a good part of the portfolio with which to generate outsized returns. But there are others that show overlaps in excess of 80%. So just remember, with smart beta, you're paying extra for something that is different from the traditional index fund. Make sure that you're getting something substantially different. And the third and final checklist item is, are the fundamentals appealing? ETF analysis really doesn't need to be that different from stock analysis. One of the benefits of ETFs in general, both smart beta funds and traditional indices alike, is that their portfolios are transparent. As a result, that allows us to conduct a different type of research by applying the traditional tools of security analysis to ETFs. So, for example, the data points that an investor would care about when evaluating a single stock, such as what are expectations for sales and EPS growth, how are estimates changing, what's happening on the balance sheet, and how is it being valued in terms of valuation metrics such as price to earnings ratio, the price to book value ratio, price to cash flow, return on equity, et cetera. All the things that you would presumably care about when evaluating a single stock can, and we would argue should, be known for an ETF. So that's the approach that we at AltaVista take to ETF analysis. What we're doing is essentially marrying the list of a fund's constituents with the fundamental data for those constituents and roll it up to the fund level so that investors can view and value that ETF in a disciplined yet familiar way. Now, the benefit of this approach, the biggest benefit, is that it's forward-looking. So that adds to the overall picture of an ETF versus many of the ETF ratings, which are really just an analysis of past performance. So there are both free and subscription resources available where you can obtain these fundamental data points to help you compare ETFs. First, you can check out etfresearchcenter.com, where any of the headline valuation metrics such as PE ratios and dividend yields and much more are available for free simply by typing in the fund's ticker symbol. And there you'll also find descriptive information such as the top holdings and the sector breakdown, which will help you in evaluating especially some of these single-factor smart beta funds to see if they are, in fact, as well diversified as you might think. If you want to dig deeper, you can also subscribe to our ETF Analyzer tear sheets on Trader Workstation. And again, Cynthia can show you where to find that at the end of the call. There you'll find our detailed analysis, including historical and forecast fundamentals and valuations. And if you're old enough to remember what the old value line reports were like for single stocks, these tear sheets are kind of like that, only for ETFs. So let's just give you one example of how some fundamental data can quickly shed light on the differences between two smart beta funds or between a smart beta fund and a traditional index fund. Returning to one of the funds that we mentioned earlier, the PowerShares High Yield Equity Dividend Achievers Fund, PEY. let's say we want to compare that to two other popular dividend-oriented ETFs, the Vanguard Dividend Appreciation ETF, VIG, and the ALPS Sector Dividend Dogs ETF, ticker symbol SDOG. Of course, we could read through the fund sales literature and understand the differences between the indices, but we're likely to still be wondering what it all meant, and especially, well, which fund is best for my portfolio. So we'll look at just two simple fundamental data points can start to shed light on some of their differences. Here we examine yield, especially since these are dividend-oriented funds, and not the yield on past distributions by the fund, but the yield on forecast dividends for each underlying constituent, as well as the forecast for long-term EPS growth. Now, long-term EPS growth is, of course, what ultimately supports dividend growth. Now, we've put these data points for each ETF, as well as the S&P 500 SPDR, ticker SPY, on the scatter plot you see here on the right, with yield being on the vertical axis and long-term earnings growth on the horizontal axis. As you'd expect, there is a trade-off between the two, with higher yielding stocks generally offering lower earnings growth, while those with better prospects trade at richer valuations, meaning lower yields. But now you know which fund ends up where along that spectrum and how they compare to the S&P 500. So that's significant because it tells you that whatever their eventual returns, SDOG and PEY, they may see a higher portion of their returns from dividends, whereas the Vanguard fund, VIG, is likely to see less from dividends but perhaps more from capital appreciation due to faster earnings growth. It tells you that PEY is more of a standard income play, while the Vanguard fund might properly be viewed as growth stocks that pay dividends. That doesn't mean, one is better than the other, but the answer is which best fits your portfolio probably depends on your particular situation and your view of the market. But this is all information that you wouldn't glean from just reading the fund's marketing materials or from their limited performance histories for that matter. So, of course, you don't have to stop with just these two metrics. Other valuation metrics and fundamental measures, such as profit margins and return on equity, they will shed further light on the kind of stocks that you're actually investing in if you purchase any one of these smart beta ETFs. So, depending on whose analysis you're reading in the financial press, smart beta may be the greatest thing since sliced bread, or it may be the devil's temptation. Our own perspective on the topic is that choice is good, and opinions are what make a market. There's nothing sacred about traditional market cap indices, but there are plenty of tools available to you to help you decide which is the best choice for your portfolio. Just remember to watch costs and make sure that if you're paying more for something that's different from the market, that you're actually getting something that's substantially different from the market. Don't pay Porsche prices for a glorified Volkswagen. And also remember to be extra cautious about the single factor funds, especially as a core holding in your portfolio, since these can very quickly become quote-unquote satellite type funds rather than something that's appropriate for a diversified core. And finally, check the fundamentals the same way you would for a single stock. If you find a smart beta fund that has the right mix of earnings growth and valuations for your portfolio, then use it if it looks better than the benchmark alternative. ETFs have brought tremendous innovation to the marketplace, including the development of smart beta funds. And even if not everyone agrees on the inherent value of those innovations, ultimately the beauty of ETFs is that, being transparent, they put you, the investor, in the driver's seat in a way you couldn't be with actively managed mutual funds. So let the three-step checklist and the tools mentioned here be the roadmap that helps get you to where you want to go. And with that, I'd like to open it up to questions. But before I do, please note that you're also welcome to contact us at the address and phone number shown here on the screen. And of course, you will all be getting a copy of these slides after the end of the presentation. If you have questions that you want to ask, please type it in the chat box, and I'll try to answer it from there. We'll pause a moment to assemble some questions, but I'll go ahead in the meantime and address one that came in earlier via the private chat. And the question is, what about smart beta for bond ETFs? This is a much less developed area, although there are a few funds that kind of fit that description. With bonds, your risk and return are not as issue-specific as they are with single stocks. So the selection and weighting of particular bonds in a portfolio is not as important as the overall mix of credit quality and duration or interest rate risk. So a smart beta portfolio for bonds might be constructed specifically to, say, hedge the damage that rising interest rates would have on a fixed income portfolio. I do know that iShares has some information on their website, particularly about this topic of smart beta bond funds, as do some other ETF providers as well. So I urge you to check that out. And again, you're also, of course, welcome to contact us directly. So now we're going to go to some other questions we've received from the chat box. The first question is, Michael, what do you think of the BMO covered call ETFs? And I would just ask Joshua, I prefer not to give any specific advice on the call, but you are most welcome to contact me again at the address or phone number here, and we can discuss offline. Another question is, what do you think about Rob Arnott warns about a smart beta crash? I am a fan of Rob Arnott, and he is the one who developed the fundamental indices back in 2004 that I mentioned at the top of the presentation. I think what he was talking about is the popularity of some of these strategies has led to a lot of people piling into the strategies that have worked well recently. There's always an element of performance chasing in anybody who's investing in something that's not exactly the market. And so, like I mentioned, some of the growth and momentum fund have those type strategies have dramatically outperformed value type strategies over the past basically since 2009. And so for that segment of smart beta funds, it's quite possible, those are very crowded trades, it's quite possible that when they reverse, a lot of people will get hurt. But I don't think that smart beta as a whole is going to crash. Again, there's nothing sacred about the market, there's nothing sacred about the traditional indices. It's just that, yes, some of the smart beta type strategies, which are, again, a subset of the larger smart beta. Some of those are very, very crowded. A lot of people piled into them, and, he's probably right. When those, trends reverse and those factors are no longer in vogue on Wall Street, a lot of people will see bad returns, and they might blame smart beta in general. But the topic of smart beta is much broader than that. And with that, I don't see any other questions. So I would like to thank everybody for attending the call. Again, I'm happy to answer any other questions you may have offline, and I will turn the presentation back to Cynthia to wrap things up.
Well, Michael, thank you very much. And if you can stay with us for a few extra moments, I'm going to take everyone out and show them where they can locate the subscription to AltaVista, as well as how to activate it within the Trader Workstation platform. So if you do, everyone, have any additional questions, please go ahead and add those into the chat panel while we're going through this presentation, or through how to access AltaVista Research. Now, notice what I'm going to do is quickly share my screen with you, and let me take you first of all into account management. In your account management window or system, you'll be able to locate under the Manage Account tab. Notice here there's a trade configuration selection where you can get into our research providers. Clicking through on this page will actually take you to our Interactive Broker Services information system, where you can subscribe to any of the features that are listed here. Now, there is a no charge for the information system platform that has been integrated into the Trader Workstation. Now, as I scroll down this window, you'll find we do include premium news services, but notice under the research, analyst research section, if you scroll down, you'll find AltaVista is listed here as well. Here, we found it. Simply hovering over the topic will give you a better idea on what's available. You'll also notice that there are several free trials that are available. I've already subscribed, so you'll see that's not available here, but if you would like to check out AltaVista, simply put a check mark in front of this window or in this box, and it will activate the AltaVista Research on your Interactive Brokers platform. Now, how do you get to it from there? Notice I'm going to bring up the Trader Workstation, and in the Mosaic interface, you happen to have Analyst Research. Notice here that, well, actually, alphabetically, you appear right up at the top, Michael. We have several different items that are available. Now, first of all, you'll find there is a hedge fund locator. But notice, as I do go in, TWS wants you to select a ticker symbol first. So what I'm going to do is simply left-click out of here. I happen to have IBM listed. And notice now when I go into the hedge finder, you'll see it comes up with a selector here for a list of ETF holdings for a particular stock. Simply enter that in, and you can find those available ETFs. Now, jumping right back into the Trader Workstation, also did want to show you that ETF alternatives are also available. I happen to have several that are listed here in my watch list, and notice that by simply selecting one of those or putting one of those ticker symbols in focus, now when we go into the ETF alternatives, well, actually, yep, let's go ahead and we'll make that selection. Let me try that again. Back into our analyst research, and we'll go into the ETF finder. Now, notice here, this selection will allow you to view a list of similar ETFs based on the overlap in the holdings. Simply enter a ticker symbol in here, and you can find those alternative ETFs as well. Now, in addition, let's jump right back into the Trader Workstation platform, because there's even a third selection here for AltaVista Research. Now, notice how you can locate all of the research articles or recent research articles that appear here. You can also even search, and let's use that same ETF, and we'll simply make that selection, and notice now how you'll get a summary report for that particular ETF. You can go in, simply launch it from here, and it should bring up a separate report. Okay, so a quick look on how you can both subscribe, start a trial subscription, a 30-day trial period, or even access any of those reports that have now been integrated into the Trader Workstation platform. So with that, I'm going to move back over into our main event window and do want to see if there's any additional questions you might have at this point. Also, I do have one piece of business I'm going to ask all of you to help out with here, and that's a poll. IB's management requires this in each of the events that we run, so you'll notice I've just opened up a polling panel on your screen. There are 3 short questions there, and I do ask your help in simply making choices here. 2 of the questions are multiple choice, so we try to do make this quick and easy. But also notice that number 2 has an input field. Don't put your questions for the presenter here because we won't see those until after the session ends. But it does make a good place if you do have any comments or suggestions for additional topics to add those. Now, poll did end, everyone, and I want to thank those of you who did participate. It really is very helpful. And if you do have those comments or suggestions, you can always send them to me at webinars@interactivebrokers.com. Well, with that, I am not seeing any additional questions that have come in today, but I do want to remind everyone that we have been recording today's event, and you'll all get a direct link to today's recorded playback soon after the webinar ends. And also be aware that the slides that Michael used during today's presentation will also be available to you as you exit today's event. They'll open up in a separate browser window where you can save that link or simply download and print directly from there. By the way, both the recording and the webinar notes will also be posted to the Interactive Broker website. Underneath our education menu, you'll find a recorded sessions button, and then look under the industry sponsored tab. Well, with that, I'm not seeing any additional questions. I want to thank Michael Krause, President of AltaVista Research, for today's presentation. Thanks so much, Michael.
Thank you very much, and thanks to everyone for joining the call. I appreciate it.
Okay. Well, everyone, that is going to conclude our session today. You can exit using the X in the upper right-hand corner, and remember to take a look for today's webinar slides as you do exit today's session. Thanks, everyone, for participating with us here this afternoon, and have a great day. Just remember all to trade smart. Thanks, everyone.